Affordability, of course, a big issue for Canadians, and that'll be hammered home during this election campaign. The CMCH says there could be more rental vacancies coming up, and that means more affordable rentals on the market. Let's start there with Adrian Rocca. He's the CEO of Fitzrovia. Adrian, thanks for coming in.
Thanks for having me.
So we're talking about the excess of condos in the market that has translated, I guess, to more vacancies or at least more rentals available for people. Are you seeing that?
We're definitely seeing an uptick in vacancy levels and a softening of rental rates because of that. If you look at the last, call it 12 months, we are down about 8.5% in terms of rents. We recently, I would say our existing portfolio are seeing a little bit of an uptick or hardening of our top line revenue, but it's still a relatively soft market. We believe once you go beyond 2025, where we have 26,000 condo units that are delivering this year, it gets into a very tight rental market, one that we haven't seen before.
So how many did you expect to be finished in 2025?
So there's 26,000 in 2025.
Yep.
There's going to be 16,000 in 2026, and there's only 7,000 in 2027.
Got it. So that'll change slowly over the years. But part of the problem, I guess, adding to what is a complex issue is the fact that now we have lowered immigration. And so that should also lead to availability, shouldn't it, for people? To
a degree. So during COVID, they ramped up immigration targets by 30%. That got rolled back, but it's still very robust immigration numbers is forecasted over the next 2 to 3 years. So we actually still see us being in a very significant structural deficit standpoint vis-a-vis kind of new supply coming into the market.
Got it. Let's talk a little bit about the trade war and the tariffs. So we know that Canadian steel and aluminum going to the south is being tariffed by Washington. I'm wondering whether any imports in your business are being affected and how it's playing out.
Yeah, so not immediately, but that will play out. We believe it's about a total increase in hard costs, about 3.5% to 4%.
Where's that coming from?
So most of that is kind of glass, metal protrusions, appliances, major mechanical equipment, some electrical equipment as well that we are importing from the U.S. So we are actively looking for local solutions that will come with maybe some capacity constraints right now. We're also looking at allied-friendly trade partners, like, for example, over in Europe. If we could actually import some of their product as well, we definitely want to lead with a Canada-first solution.
A Canada-first solution is what a lot of people are looking for. Is there availability in sort of what you've looked at so far or the research you've done? Can you easily move towards a Canadian supplier in some of these markets?
In most cases you can, but it's at a more expensive price point. So what we really need is some government intervention, some government help. It could be policy reform. It could be changing the economic model so it allows us to actually buy more Canadian products.
Okay, so we're talking about what's happening so far. April 2nd is still to come. Mm-hmm. Are you guys planning with that in mind? And if so, what are you taking into account?
Yeah, so we're actively having conversations with all of our trade partners to make sure, our trade contractor partners, to make sure that we understand where the supply chain lies, what are some of the risks around some of our existing contracts.
I was going to say, are you locked into contracts that would avoid you having to deal with the uncertainty of prices?
We are in some cases. We actually are in the process of renewing existing contracts. And so obviously there's tariff language that gets included in that we're going to have to work through.
Did you have to push up any contract renewals in light of what's going on?
We've tried. The reality is everyone knows about the tariff headlines, and so our counterparties are obviously looking to protect themselves. It's the reality of their business and the reality of ours.
Interest rates have been going down. Have you noticed sort of consumers coming out of the woodwork a little bit more because now they feel like it's more affordable? But then on the flip side, you have uncertainty and the threat of a recession. So what do you see? Are people coming out or are they still in a holding pattern?
Yeah, so to be clear, we're not for sale condo developers.
Sure.
We only specialize in purpose-built rental. But what we are seeing is the condo market's still very quiet. So even we're also seeing a drop in interest rates. And, I'd say if you look at the forward yield curve, that continues to trend downwards. We're still seeing a lot of buyers on the sidelines. There's a lot of units that, were sold at much more kind of elevated prices to what we think is the market price for condo units today. And so that needs to work through the system right now. We're still seeing a very quiet for sale condo market.
You mentioned, obviously, you'd like some of the federal party leaders should speak to certain issues. Give me an idea of what more you want to see from them.
Yeah, so we would love and very active in the market talking about a full development charge waiver and property tax waiver for 20 years. I think we should go beyond that. So what does that mean? I'd love the concept of a 1031 exchange, which is what they have in the US.
Which is what?
Which allows basically if you own an asset and you sell that asset, you could defer capital gains if you redeploy it into a similar profile asset. So that would be one great example. We need to create a framework that allows foreign capital and domestic capital to want to invest in Canada. So that would be one piece. The second element I would say is around reform vis-a-vis how infrastructure is funded. Right now, infrastructure, the obligation of that infrastructure is funded through a development charge. That development charge is a cost to the developer. The developer cost of capital is double digits, call it 15 to 20%. And so what I want to do is replace that cost of capital with cheaper forms of cost of capital like infrastructure bonds or municipal bonds, which has also been a very effective funding tool in the US, certainly in the Sun Belt, where we could bring retail capital and institutional capital to the table to actually invest in our infrastructure versus put the solution on the end consumer indirectly, but more directly on the developer.
Okay, so let's talk about the carbon tax for a moment as well, because Mark Carney's removed the consumer part of the carbon tax. And of course, the Conservatives are saying if they win power, then they will just scrap the carbon tax altogether. Does this benefit you in any way, the way things stand right now before, of course, the election was called? And what are you looking for there?
Anything that's going to create, like the economic model, the funding model is almost broken right now, right? Anything that's going to change that, the flip it's on its head, we're big supporters of. So that means everything from moving quickly through zoning, permits. It's
the regulatory,
which is table stakes. But the reality is we're sitting on millions of square feet of fully zoned, ready to go sites. The funding model does not work. The economic model doesn't work. So 30% of total development costs is actually municipal fees, government fees, levies. We have to be able to remove that, right? Have a short sunset window, right? As these other kind of infrastructure funding ideas come into play, that's going to take time. But you got to get as much new supply into the market. So you have to waive those costs today, right? The longer this goes by, we're going to have 3 to 4 years of effectively no new supply in the market. That's not good for developers. More importantly, that's not good for the average Canadian consumer.
Got it. Adrian Rocca, good for you to come in. Thanks very much and appreciate